In today's interconnected economy, a global framework is essential for navigating the markets. While headlines differ in Tokyo, London, and New York, the data tells a unified story through one language, the charts. Understand this science is key to translating market psychology into actionable intelligence. I'm Flavio Lemos, chartered market technician. On the Traders of the World podcast, we decode this global data-driven conversation. Hello and welcome back, everyone. We are just days away from the Thanksgiving here in the US. While most people are focused on carving the turkey and debating football, traders are focused on carving up support and resistance levels. We are here to decode the market. For such a special occasion, I'm not alone. I'm thrilled to be joined to my co-host, Rafael Bentes. He's a veteran trader with 25 years of experience. Since 2019, he has been at RJ Asset as a CIO, managing the group's international accounts and leading wealth management for Brazilian clients. Hello, Rafael. How are you doing?
I'm doing very well. Thanks for having me. So for this great conversation with Craig. So let's go.
Okay. All right, team. Before we dive in, the ritual sacrifice to the YouTube algorithm. If they shot deposits any value to your knowledge account, smash that like button and subscribe. It keeps the light on and my caffeine levels adequate. So today we are joined by strategic heavyweight, a professional who has earned his hand not by echoing the crowd, but by often standing against it. His strategist who has earned the rank of managing director at a top firm. But he's not just a big title. He's one of the industry's most respected technical minds, known for issuing bold and contrarian calls. He is Craig Johnson, CMT and CFA, the Senior Technical Research Analyst at Piper Sandler. He is here to help us decode the markets. So, Craig, it's an absolute pleasure to have you on the show. Welcome.
Thank you for having me on this show. It's great to see you, Flavio, Rafael. Great to be on. And, we're joined here in cold little Minneapolis here today, but hopefully it's going to be a hot show here today.
Yeah, I will get you warm now. So here's the plan. Grab your coffee, make it a double, and focus right after the intro. Don't go anywhere.
You ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
Okay, great. You have been at Piper Sandler for about 28 years. Your career began in college when you got hooked on stock picking, partly through the William O'Neill books. What was the first key lesson that made you trust the charts over traditional fundamental dogma, especially when so many viewed tech analysis as voodoo?
Mm-hmm. I think what really got me hooked on this is I always sort of knew that I was a visual learner, and I was also an individual that liked to look at charts, liked to sort of figure out how to trade, understand the levels and those things. And I really got started looking at the blue book and the green book from O'Neill when I was in college. There was a gentleman working in our office. I was working at a place called the Small Business Development Center. And he would come in, he was looking at charts all the time. And I'm like, what are these books? And he would give me the week-old books, and I would study those for hours and hours and hours, going through them and looking for the best patterns and setups. And then I just started going through, and I went to the library one day, and I basically checked out every book on technical analysis, and I just started reading all these things. But, Flavio, I got to tell you, I knew I was hooked when I was sitting out at the pool, and this really lovely individual comes walking by the pool, and they go, "Hey, Craig, what are you reading?" And I go, "I'm reading Stan Weinstein's book on profiting in bull and bear markets." And this person looks at me and goes, "You're such a geek," and walked away. And I just said, "Oh, well, who cares? I'm reading about Bull and Bear Markets by Stan Weinstein. So then I knew the choice I made that day, I knew that technical analysis is something I wanted to continue to keep doing. And I've been doing it now for 30 years here at Piper and enjoying myself tremendously every day. I keep saying to people, and Ralph Akampora has said it, if you find what you love to do, you'll never have a job. And that's sort of how I've viewed this over the years.
Yeah, Ralph is a wonderful mentor and a good friend for all of us. So, Rafael, shoot one.
Yeah, so Craig, you often reflect on advance to being based outside the New York bubble, fostering independent viewpoints. Was a strategic decision from day one, and how does being removed from the daily Wall Street clamor influence your ability to stick with contrarian call?
So it wasn't necessarily strategic. I just knew that when I got done with college, I wanted to come back to Minneapolis, and I was looking for a place where I could do technical analysis and really kind of put a stake in the ground and do these things. And at the time, the company's name was Piper Jaffray at the time, and actually Piper Jaffray and Hopwood, to be clear. And so I just kept calling the technician that was working here basically every day for 6 months. And I said, hey, it's Craig. Just wanted to check in with you, see if you got any spots. Can I come in? Blah, blah, blah. Call them every day. And they're like, finally calls me back and he goes, you are probably the most persistent person that I know. You clearly know what you want to do. So come on in. Met with them and started from there. So my decision to be outside of New York wasn't necessarily strategic. It was more where this firm was headquartered and still is headquartered here in Minneapolis. And that's where it is. But I do tell you, Raphael, that I do think being outside of New York, there's a lot of technicians that have been in Minneapolis outside of New York. You had Steve Luthold, who was here, God rest his soul. He also started at Piper years ago, and a lot of the work that I keep up today was created by Steve and others. You also now have Doug Ramsey, who's another great technician that's been here in Minneapolis. But I do think sort of being outside of that kind of East Coast mentality and think allows us to sort of think about markets kind of in a more strategic way and not be in sort of that group think. I think group think is a really sort of, it's sort of a problem, I guess, from my perspective. You want somebody who's giving advice and doing these things to be thinking about markets and charts and things independently. And I think there is too much group think in New York, respectfully. Doesn't make it a bad place, but being here in Minneapolis and working at a firm such as Piper Sandler now, where they do respect all sorts of different opinions and viewpoints, and certainly having a firm that supports you in that way, I think it really helps us to have that sort of contrarian viewpoint. And it's okay to have a contrarian viewpoint. And it's okay to be wrong. You just don't want to be wrong for long in the business that we're in. And from that perspective, it's been a great environment and a great place to have a career over the last 30 years here at Piper Sandler.
You said you worked under technical legends like Steve Luthold and Ed Dikoski at Piper.
Correct.
They created the legendary War Plan, a statistical book. What was the most profound piece of charting philosophy you inherited from that legacy that you still apply today?
Well, they created something. Steve created it, carried it on by Ed. But there's something we call our microgroup project. And the microgroup project is where we go through and we categorize basically every stock above a 25 million market cap and a $2 price into 416 industry groups, and then wrap it up into 12 economic sectors. So that has been terrific. And many portfolio managers across Wall Street do enjoy looking at those charts because it helps you sort of say, is this an individual company specific issue, or is this a bigger trend and theme that's sort of playing out in the market? And we want to find those trends and themes and ride those trends and themes as we see them unplaying in the charts. The other part that Steve had created was something that he called MACE, and it's moving average cycle evaluation. And that particular indicator just uses 4 and 16 and 32 week moving averages so that we can actually look at crossovers. Sorry, 4, 13, and 26 week. I said that wrong. 4, 13, and 26 week moving averages to help determine if stocks are in uptrends or downtrends. And then the other great piece that they created was something else they call Technigrade, which is a numerical form of relative strength that is sort of the heart and soul of the war plan book that we put out every single week. It really helps us understand and hone in on the 2 most important things that these big portfolio managers care about, which is number 1, how is my stock trending? And number 2, how is it trending relative to the rest of the market? That's all they care about. At the end of the day, I'm talking their language every single day. And with these particular tools, I can now come into a portfolio manager and pretty much help them and say, hey, you've been watching some of these momentum variables, quantitative variables, and these other things. But if we simplify everything down, trend and relative performance is really all you care about.
Your analysis relies heavily on long-term charts, data that goes back decades. When you sit down, which single history chart, S&P, Dow, or a ratio, do you look at first to establish the big picture? And if you could share some chart to us and illustrate the multi-decade scene could play out, it will be great.
Yeah, so some of the charts that I'm going to go to every single week, and let me just share some of these on the screen here real quick.
Okay.
Okay, so some of the things that I'm going to go to every single week anyway, yes.
Okay.
I assume you guys can see that okay?
Yes.
Yeah.
So one of the things that I like to look at in that fabled war plan book that we put together is I like to look at what is making 26-week relative strength new highs and new lows every single week. And the reason I look at this is because it helps me understand the advance and the participation in this market. Everybody is super bulled up on this market, and I keep looking at this and I'm saying, wow, I got insurance companies, marine, dry good carriers. I've got diagnostic services. I've got banks. I've got some utilities. I look at this and I'm like, this is not really the composition of a market that's ready to take a springboard higher. I also will go and look at the same thing with absolute new highs and new lows. Same sort of thing that I put together. And then having done this for a number of years, I also sort of make a determination that, wow, I got a lot of cyclical stocks, which typically do well in the early stages of a new bull market, that are in my 26-week price new low list. So that, again, sort of tells me the mindset of this market, the composition, and the setup. And then, Flavio, great question. And one of the other things I also look at, coming down to here, to help me figure out what sectors I should be over and underweight every single week, is I create these other charts in here that, and let me make this bigger for you.
Okay.
And I'll go through and I'll look at this. And like, here's the energy sector. Okay, so I said we take every stock above a 25 million market cap, $2 price, and then I will divide it out against our microgroup index, weighted and unweighted. Okay, so the microgroup index is an index, again, of every stock above a 25 million market cap, $2 price. And then we've got it broken out into 12 different economic sectors. And so one of the things that I like to do every single week, Raphael, is I come through here and I say, hey, if I'm going to be in a normal distribution of recommending to clients to be overweight 3 sectors, underweight 3 sectors, and neutral 6, if I come through these charts very quickly on a weekend, I can come through here and say, should I be excited about energy right now, given these particular relative trends? The answer is no. And then I'll keep going through and I'll keep going through these particular charts, and I'll force myself into that normal distribution. And Flavio, one of the groups that has come into my attention a lot lately has been healthcare. So anybody that looks at healthcare, of course, nobody's looked at healthcare for a while, but look what's starting to happen with healthcare on an unweighted basis, meaning your mid and small cap healthcare stocks are starting to improve relative to the rest of the market. And look what's happening on even a large cap basis. We're at that technical inflection point. We're starting to reverse a downtrend. We're starting to move above some very simple moving averages. Now, I start with this because I'm starting at basically top down and bottom up at the same time, because I'm looking at every single stock in the market, but yet boiling it down to a top level sector recommendation. Because what I've found over the years is a lot of investors spend a tremendous amount of time trying to figure out, are the earnings going to be 1 penny higher or 2 pennies higher? And what does that ultimately mean? For me, I have found that if I can get 2 out of my 3 sector calls and recommendations right for the year, my best performing names in my worst performing sector are probably going to do better than the other parts of the market. Okay. So if I get these sector calls right, the differential in any given year going back to 1969, as Steve Lutho had always told me, he said, Craig, if you get those right, you're going to find that your differential is somewhere between 20 and 30% pretty consistently every single year. And that has indeed been the case. Doesn't matter how much quant computing comes online. It doesn't matter what the quant analysts are doing or everything else. Getting that sector call right and then drilling down into the industry group and then picking your stock has been ultimately how we've been able to have a good, solid track record over the years. And so these are some of the charts that we've been looking at, Flavio, over the years as just an example.
Okay, thank you. Rafael, go on.
So I see your research delivers in deep analysis of sector and has a healthy appreciation or relative strength. You have mentioned using your barbell approach, overrating 3 sector and underrated 3 sector. So how does relative strength guide your rotation to find the next winner and keep your portfolio balanced?
Yeah. So how it's going to help me understand when the changes are taking place or when the rotation is taking place, it's going to be that disciplined process for us of forcing ourselves into 3 overweight sectors, 3 underweights, and 6 neutrals. And when you look at any of our publications, from our daily notes to our weekly updates, I'm very upfront about what sectors I think we should be overweight, what we should be underweight, and what we should be neutral. Okay. Now, healthcare has just started to turn around. And now the decision process comes for me when I put out our big monthly book here in a few weeks is, do I downgrade financials, industrials, or tech to take up healthcare? And that's going to be one of the key decisions that, I'm going to be making. And how I'll make that decision is I'll come back to those relative charts that we were just looking at. And then I'll also go and do a deep dive and sort of look at what all the individual charts are telling us. And this here is a 1-page summary for me. Every single week we score not only those 416 industry groups in a outperform, neutral, or underweight rating. We also look at them on an absolute scale, kind of like my grades in college, A through F, right? And then we will ultimately score individual companies based upon our technical methodologies, and we'll score around 3,200 stocks every single week. And we'll build these things up we call weekly homework grids. So if I go and I compare healthcare right here, and then I want to go also through and say, compare that with, say, the financial sector, you can see where a lot of these charts have been popping up on either pullbacks or negative developing for financials. You can also do the same sort of analysis with the technology sector as to where a lot of these stocks are pulling up as, and make a very quick, educated approach to where we should be over and underweight. And again, a lot of people sort of get tripped up with thinking about weightings in the markets and all these other pieces. I'm just trying to find good looking charts, good looking things that are moving. And you can go through and look at all these over and under weights, Raphael, and that helps you drill into the discipline in the process. But I really want to stress to all your listeners, trading is got to be a disciplined process. Again, I'm going to say it again. Trading has to be a disciplined process, not only from how you're going to source your ideas to what you're going to do for your risk parameters, to how you're going to position those trades, how you're going to size them up, how you're going to size them down. Has got to be that disciplined process. And for us, it's repetitively for years going through and looking at charts over and over again to help us understand the rotations and where ultimately to be positioned.
Great. So great. Let's talk about the Russell now. You have expressed optimism about the small cap and the mid cap stocks. You cited chart pattern like inverted head and shoulder. And can you pull up the Russell 2000 charts and show us what you have seen? Is the pattern still sign a potential breakout or buy opportunities?
Still 50 in line. Yeah. So what I've been watching with the Russell 2000 chart, and again, I made pens about 11 months ago that said Piper Sandler R2K to lead the way. Okay. And I really still continue to think that the Russell is going to lead the way. Part of my thinking for this is simplistically is first off, the Russell hasn't gone anywhere in a long time. And if we're going to start to see some rate cuts, we know that typically small mid-cap stocks tend to perform better. We also know that looking at the setup in here, big consolidations like this will ultimately lead to potentially a breakout. And we can sort of measure what that breakout potential can be, which is something closer to about 3,200 on the Russell 2000 index once we finally break out to those new highs. I suspect we got one more kind of pullback in here that probably takes you back closer to the 200-day moving average. You can see the big consolidation setup. You can see the left shoulder, the head, and potentially the right shoulder forming. And then I think you're going to have a pretty decent move. Now, I love to take not only the technicals and the charts, but also take some of the fundamental knowledge and put it together and think about the composition of the Russell 2000. Everybody's called it a garbage index for years. And the reason they have is there's a lot of biotech in there that doesn't make any money or have any earnings, nor should they, right? Because they're sort of development stage companies. And with that being the case, it's been about 3-4 years since biotech has worked. We also know that the pharmaceutical companies need to replenish their pipelines. They're going to go in and buy some of these biotech companies. And when you do, you're going to kick off an M&A wave that will probably be quite exciting to watch. That said, that's really going to help biotech, and it's going to help the Russell 2000 index given the composition. And by the way, to put it into another perspective, when you go through here and you look at what is making relative strength to new highs in the market right now, what did I show us right over here? Look at that. Biotech, large, primary, and secondary are among the best relative performing stocks in the market right now. So again, from my perspective, I guess what I would say is I think the Russell's setting itself up for a very nice move. But that's what I'm seeing charts and rationale-wise. And if we get another rate cut on this, at the next Fed meeting, it's only going to further help my cause.
Yeah, there is a big base. Hate is probably going down even further. So maybe you have a good cover here. You often discuss investor sentiment, noting that a negative mood can precede positive market moves. When everyone is running for the hills, what's your favorite breath indicator? Which do you want to track? That sign of capitulation and that contrarian moment to buy, even when everything feels wrong. Could you show us?
Yeah, so I would say that tops are generally processes and bottoms tend to be single point events that happen, okay? And this market, again, I'll show you how I do this. And what I'll tell you is this market's getting more volatile. And I'm sort of a believer that cash really should be an asset allocation category. Okay, I'll say that again. I think cash should be an asset allocation category. None of the consultants that work with these big funds are going to say that should be the case. They believe that people should be fully invested at all points in time. I understand that. But when you look at what's been happening with this market post the great financial crisis, it's become a lot more volatile. Okay, and let me show you on this chart why, and I'll show you how I figure out some of these bottoms. But if the great financial crisis is right here in this time frame, you can see that before this, since 1987, you only had 4 instances where this particular indicator, which helps me identify bottoms, has been triggered in a very meaningful way. And what I mean by that is this indicator, percent of microgroups above their 40-week moving average, is telling me what percent of those 416 groups are still above a simple 40-week moving average. And when you get to sub 10% readings, read as 90% of all the stocks are below a simple 40-week moving average, you're kind of at a very important inflection and washout point. And so to that point, that is one of the tools that I will use. And you can see that almost in every case, it has been a V bottom, not a U bottom, a V bottom. It was a U bottom in the great financial crisis in 08, 09. Okay. It was a little bit of a U bottom in 87. But for the most part, these markets sort of wash themselves out very quickly. You make that V bottom and you come back. But to the question you guys are asking, this indicator has become 50% more volatile since the great financial crisis. And the reason for that happening is really simple. You got more ETFs than you have individual stocks now. Okay. And I know that, Flavia, when you buy an ETF, you probably buy it because there's a theme with it, not because it's cheap. Right? I want to buy an exposure to uranium. I want exposure to internet computing, et cetera, et cetera. Well, that means that valuation, and again, don't take away my CFA when I say this, but valuation's got to get a larger parameter around it because people are buying and selling not one stock, but hundreds of stocks at a time when this happens through the ETF mechanism. And it's leading to a market that, in my humble opinion, looks more like an on-off light switch than it does a dimmer knob that you can sort of dial up or dial down based upon the valuation metrics, because you're selling entire markets in one single decision. And to that point, talking about risk and trading, okay, for everybody that's listening here today, 1,600 ETFs own Nvidia. Okay, so if Nvidia has a bad day, the market's going to have a bad day. And that's where you're getting to some of the concentration risks in this market that I don't think necessarily people truly appreciate. And this tool and this chart that I'm showing you here is one of my go-to charts that when I got to the washout levels like we did in April of this year, and everybody's saying, Craig, this market's going a lot lower. I'm like, no. You've already washed out this market to such a degree. I want to be the contrarian. I want to lean into this market, and I want to be buying it. And that's exactly what our message was then. And I look at this market now, and I've been watching a pretty healthy contraction in the number of groups that are above their simple 40-week moving average. I'm not sure you're at kind of the puke washout point quite yet. I think you're building toward that, but you're not there quite yet. But that is one of these tools that I'll use that sort of answers a number of questions that I know that the listeners want to know.
I was talking to Walter Deemer. One of my questions was, why so difficult to find those thresholds on any breadth indicator? He has his own breadth indicator, the breakout indicator, breadth movement indicator. So you are using percentage of micro groups above a 40-week moving average. That you just told that when you get the ETF, you are selling a bunch of stocks at the same at once.
Mm-hmm.
So is it the problem with the S&P 500 to try to get these breadth indicators with the S&P 500, because you get a lot of Nvidia, you got a lot of the FANG stocks, and the old guys use the New York Exchange stocks, now like 3,000 stocks instead of the S&P 500 or the Nasdaq 100. Do you think is more valuable the Russell with 2,000 stocks, or the Wilshire, or I don't know, to make a good breadth indicator?
I think it's important to have a broader number of stocks to make this sort of breadth indicator and discussion. If you look at the S&P 500 specifically, you're not getting down into the real small mid-cap kind of companies. So you're sort of missing out on some of that participation below the surface that I sort of want that granularity to understand. You also have a scenario where the S&P 500 composition changes on a fairly regular basis. So if you're trying to measure something, but it's a moving measurement of what you're trying to measure, that makes it a lot more difficult to truly understand history and sort of put the pieces together. So what we've done at Piper is we've created all our own sort of industry groups like this to be able to track these different pieces. And we've created, again, those 416 groups to really help us understand breadth. And that's where you'll come back and we'll look at something like, say, hey, look at the off-price retailers as an example. This chart goes back to 1985, and you can look at this chart and say, wow, we're now breaking out above the 22 highs. Nobody else has created charts like this and have been able to curate them going back this far, because we literally started these charts in the Steve Leuthold, Ed Nikoski kind of days back in the 1985 period. And we've been curating those charts and indices going forward from here. But that's what I think helps us with breadth. And I think the more companies you have there to help understand breadth helps you understand the health of this overall market from our perspective. And again, I love Walter Diemer. I love all the work he's done. He's absolutely one of the most proficient, fantastic technical people on the planet, and love all the work he's doing. For us, slightly different than what Walter's done, but I think equally as valuable from our perspective.
Yeah, he's a great guy. Go on, Rafael.
So, Craig, you mentioned the American runs on two things, cheap food and cheap fuel. You also watch inflation along with gold, oil, and other inflationary factors that would impact stocks and bonds. What are your current technical read on this correlation between those commodities and the equity market reading into the next year?
Yeah, so as I go through and I start looking at the correlation between equities, commodities, and these other pieces, the first thing that I like to do is I like to pull up my big long-term chart of interest rates, right? And when I mean long-term chart, this is where I really mean long-term chart. So I want to show you this other chart real quick. I'm going to pull it up. I just updated it.
Oh, great.
And when I look at this chart, and again, I really like using Python, and I really like using some of these tools to help us automate a lot of things. That's one of the biggest challenges for technicians is to be able to automate things. And let's see here. I'm going to move this over here so you can see this.
Yeah.
But this is I define a long-term chart. It goes back to a little bit before 1880 to think about interest rates and 10-year bond yields in the United States. And as a technician, wasn't that long ago that we reversed a 40-plus year downtrend in interest rates. Okay. And what I find fascinating is when I go back as far as I can go from the government data site for interest rates, it's really interesting to me that coming off of the 2020 lows, we came right back up to the long-term sort of levels in here. It was 4.48%. Wow. Okay, that's interesting. But all us technicians know that when you break a long-term downtrend, you might surge above it, but you come back and you retest. I remind people that the retest, and Ralph talks about the lower lows and lower highs, back in the 1980s, that took 5 years to play out. 5. I don't think it's going to be any shorter this time around to really come back and say, pull back before you take another leg higher for this. I think the correlation right now with interest rates as I watch this, and then let's bring this into a current Bloomberg chart for interest rates. And when I do that, I sort of see that longer term trend sort of playing out like this. I think we're going to, in the next year, re-enter this downward trending channel. And I think that will ultimately be positive for equities to a point. Lower interest rates should be positive for equities. And if we start going below 3%, something is going to be seriously wrong and broken. But if we see interest rates pull back from here to 350, 375, I think equity markets will be just fine with it. It'll be okay. 30-year mortgage will come in, which will be supportive for the economy and supportive for the builders. And that the correlation there, I think right now, is lower rates, higher equities is probably how that correlation is going to play out for now. But that's a great, very astute question.
It's perfect for Russell. Maybe, it's the rate falls. I think the Russell is going well.
Yeah, I mean, if Russell comes in, if we see interest rates come in, great, the Fed is cutting, et cetera, that'll be a risk-on move, which will definitely benefit the smaller mid-cap stocks. 100% agree.
Great. We come to the hour that we ask every guest this question. The trading confessional. Let's talk about the t-shirt call. Which was your best call or trade? The one you are most proud of, where the technicals and the macro align perfectly? And what was the worst trade, worst call, the one that was humbling, and what was the big lesson you learned from it?
Yeah, so I think my best call, and we actually made t-shirts and did all that kind of stuff.
Olá, espero que esteja gostando da entrevista. A Trade Brasil foi eleita por 2 vezes no Rank Awards 2024 e 2025 como a melhor academia de formação de investidores do Brasil. E ela tem um presente para você que está assistindo esse podcast. 10% de desconto, é só usar esse QR Code que está aqui embaixo e a gente te espera lá, ok? Agora não esquece de dar uma moral pro Flávio. Curte, compartilhe esse vídeo e se inscreva no nosso canal, ok? Até a próxima e obrigado pela presença. Valeu!
So probably the best call that I have made thinking back in the past, and I'll pull up this chart to show you how it played out, was basically back in 2011, 2012 timeframe. So one of the frustrations that I have working on Wall Street for years is there's a lot of, the old saying is, you never want to put price and time into the same discussion. Okay.
Craig, I don't think you showing your your screen on the right.
Yep. Give me 1 second. I'm going to pull it up over here.
Okay. You are just telling about price and time, and
Yep.
Yesterday I interviewed a guy that was a gun fan. So you always talk about price and time at the same time.
Correct.
That's
Correct.
great for the audience because we got a lot of different views from technical analysis.
Right. And so from my perspective, I get frustrated. And this is a chart that I wanted to show you. Okay. Back in August 21st of 2012, I did the most sinful thing you're not supposed to do on Wall Street is I put price and time into the same note, not once, not twice, but 3 times. And I said that in 6 months, the S&P was going to reach 1550, and I gave the date, and we reached it basically right on time, like almost to the day. Then I said in that same original call, we would go to 1700 1 year later. We got there. Now, unfortunately, I did miss the 2000 call by 3 days, which my father reminded me of, though he missed a 2-year call or a 24-month call by 3 days. But I would say this is probably my best call that we made. And you can see over time with the methodology of using technicals and putting these pieces together that it works. It absolutely works. And we put this together. I would say one of my worst calls probably has been probably getting out of Nvidia too early has been one of my worst calls. I thought 16 times my money was enough. Clearly it kept going and it's gone on further from there. But that is certainly one of the worst calls we've made. There's other calls in all humbleness that we've made that have not been very good. We raised our price target here in 22 at the highs, and it promptly corrected on us. We had to go back and change our target twice for the broader market. So again, nobody's perfect. We all got to be sort of humble, hungry, and how we're all putting these pieces together. But I would say that is some of our best and perhaps worst calls in all humbleness. There are other individual equities that I could call out. Buy a biotech stock and they fail their data, you go from $6 to $1. So we all have those moments, but we just have to keep in mind what the risk parameters are and be able to sort of size the position correctly so it's not very painful for the portfolio.
That's why the stop losses exists.
Yeah, that's why we use stop losses. And even though I may not officially put the order in for the stop loss, I always write down the levels that, okay, I'm out if we get to these particular levels, and then come back and reevaluate and say, maybe we got the right idea. It just may not be the best time to execute this trade.
Rafael, last one.
So, Craig, so final of this conversation. So, let's talk about your side project that reading hitting your Minnesota housing 20 degrees below zero, whether you're using your light coal miners.
Yeah.
How has that very real and physical experience with energy markets and computational influence your view on the long-term viability of the cryptocurrency? So
you're hitting on an important point, and it was years ago, 2016, 2017, when my oldest son injured himself playing hockey, and my wife says, you need to create a father-son project, and that's exactly what we did. He came to me and said, let's mine cryptocurrencies in the basement and make some money. And I said, you got me at hello. I got to burn up electricity, play with tools, make noise, play with my network, do all these kind of things. I said, I'm in on all this. Like, I love this all. So for years, we heated our house, but electricity prices have gone up. And so I've actually moved the miners out of the house. I can't heat the house anymore with them, sadly. But for years, the Johnsons would walk around in shorts when it's 20, 30 degrees below zero, because we had so much heat coming out of the crypto miners. And we'd recirculate that heat right back into the cold air return on our furnace. And I didn't really have a gas bill. And that was really interesting because I often got a knock on the door when it's 20, 30 below zero. And they're like, your gas meter isn't running, but yet your house is really warm. Can we come in and see what's going on? So I had the sheriff over a few times, especially when the electric bill was running, $3,000 a month. So they wanted to know what we're up to, but that side project of crypto has been a great educational experience. And so we still mine. We just have the mining rigs up in North Dakota now, where we can get stranded nat gas for 4 to 5 cents a kilowatt, produced into electricity at that price, and run the miners up there. And it's actually good. My wife isn't angry with me anymore about making a lot of noise in the house and having $3,000 a month electric bills. So that's been a win. But crypto from here, the question I get from everybody is it a legitimate asset class? The answer is yes. And it's getting even more legitimate as the current administration is coming on board with stable coins and these kind of products. And I do really believe that companies like Circle International, that is a big proponent and a big curator, I should say, if that's the right word, of stable coins. And stable coins are also going to be really helpful to the U.S. government, because Circle is probably going to buy $4 to $5 trillion of U.S. debt to back those stable coins. And I do think that stable coins, specifically USDC, is probably going to morph into the digital dollar. And the implications internationally from here are huge. We want to do business with Brazil. We don't have to go through a big money center bank anymore to do this. We can just send you some USDC and you are perfectly happy. So it's going to make the dollar even more global than it already is. And it's all going to get backed with US treasuries. And the fact that China has not been buying as much of the US treasuries, we've now created a long-term stable buyer of US treasuries. And what does this mean for Bitcoin itself? Bitcoin is still going to be a store of value. It is the digital gold, and so is Litecoin, and those are still going to be used. But for commerce and international transactions, you're going to see that done with USDC. And on top of it, you can get paid a very nice rate on it right now, 4 and change percent, and you can lend it out and get a 6 and change percent on USDC on Coinbase. And that brings me to the other part of the digital ecosphere, which is Coinbase itself. We need a really good on-ramp and off-ramp to sort of connect up with the digital world. And again, Coinbase and probably Robinhood are your two best, most reliable ways to do that at this point. The only thing that would make Coinbase even more strategic is if we start to see them get FDIC backing and insurance. That would really open up the door for cryptocurrencies and Coinbase specifically, if that was to be the case. But cryptos aren't going away, Raphael, at all. Like, they're here. And I would say from a trading perspective right now, I'll be a buyer of Bitcoin 75,000. It's going to correct a little further. And then you're going to start perhaps consolidating and then start another leg up.
Great. I actually, we have the same view for the stable coins. I think it's going to be a passive buyers of the treasuries, and they they will supply this demand of the U.S. market for money, and it's good for dollar.
Great for the dollar. Great for the dollar, great for the debt the country has, and great for international commerce at a lower price too. I mean, it is not easy sometimes if you got to go do pay some bills, go through the big banks, get lines of credit, get all those other things done so you can go do these things. So now you can just do it instantaneously with USDC.
Perfect.
Finally, as a former president of the CMT Association, we have trained the next generation. What's your must-read list for aspiring analysts, and what is the single most important piece of advice you would give to someone entering this profession today?
I think the most important advice for people is, I got a couple, so sorry to go on here for a second. No problem. I think the first thing is, for people coming into this business, is realize that it is a great group of people. There's a lot that can be learned amongst each other here in the technical community. And so I encourage everybody to always participate, to give back, and to always be there to help support other members in the association, which has really been sort of the draw to me over the years, which has been great technicians, whether it's Bollinger, whether it's Walter Diemer, whether it's Ralph Acampora, whether it is any of these technicians. we have great relationships among all of us. And it's very different than what you see on the fundamental side of the world. We're all supporting each other. We're all looking at each other's work. We're all providing constructive feedback. It's terrific. So be part of that community, engage, and also always give back to the younger generation coming up, because you don't have an association if you don't. And you do need to continue to do that. I'd also say more pointed things for younger generation coming up is, don't forget, technicals are really just a shortcut to the fundamentals. So you do need to have some fundamental sort of backing behind what you're ultimately doing. There isn't a single technician, there isn't a single portfolio manager in the world that doesn't look at charts. They all do. But you also need to keep in mind that you need to understand mechanisms behind the surface. The third point I would make is, make it straightforward and simple. I know that makes me sound like somebody called me an OG, I guess original sort of technician, old kind of guy, right? But at the end of the day, I've had conversations with portfolio managers in every continent, everywhere around the world. And the thing that I find that is most important is to make it simple. If you come in there talking about all sorts of more complicated things, you're going to lose them. And that's where I think technicians have gotten a little bit of a bad rap, is because we've made it too complicated. We need to make it straightforward and simple is what we need to do. So that would be my advice. And then lastly, one last thing.
Okay.
The younger technicians need to understand Python. And you need to understand how to use Python, integrate it into your workflow, and you can use AI to help you. I write a tremendous amount of Python scripts to automate every single thing I'm doing. I've learned from my good friend Ralph over the years, the most difficult thing that we have as technicians is to be able to scale your business, because it is such a hands-on business that we have. And being able to scale it, being able to save yourself time, write charts, PowerPoint decks, et cetera, you can do that with Python. And I definitely frighten my IT team on a regular basis with how many things that I am running all the time. But nonetheless, Piper's been a great friend and certainly a great partner to work with, as they've been sort of embracing, allowing me to explore these things.
Don't forget the must-read list, please.
So, I'm sorry, the what?
The must-read list for aspiring analysts.
Oh, the must-read list? Yeah, I think the must-read list for me is, I always started with Edwards and McGee. And I went through the Edwards McGee books, and I went through the Murphy books. I thought those were some of the best pieces out there to ultimately go through in terms of understanding these. And again, I wouldn't be where I am without Stan Weinstein and him, really getting into my mind about bull and bear markets over the years. So I owe Stan a gratitude of thanks from that perspective, and also have to thank Steve Leuthold over the years for all the great work he's done, Ed Nikoski, the great work he's done. And then one last thing from the to-do list is the O'Neills. The O'Neills have been absolutely fantastic with the products that they put out over the years and how terrific they are. And then also Tom Dorsey with all the point and figure work that he's done. All these things are just absolutely seminal work that have been done by these great technicians that we owe a great amount of gratitude and debt to for all of them. And everybody that wants to be serious in the space should be reading those kind of publications.
Craig, you have mentioned a thing, and it's very true. I must admit it's very true. I always talk with other technicians, Bollinger and Bollinger family, Zoe, Dorit. They are part of my family. They were here in Brazil in June, July. They were here. We have a lot of fun here together, have lunch and a lot of beer. So we are a community. Bollinger always call me to ask some recipe for barbecue or something like this. So we discuss other things than technical stuff, but it's a great community. Rafa Campora, I sent him a cachaça bottle. So I'll send you another one if you like to taste a caipirinha drink. So
sure.
It's a great community, and I hope to see you on next symposium.
Absolutely. We look forward to seeing you there.
Yeah, okay. So, Craig, this has been a master class in blending Wall Street experience with true technical discipline. Your ability to issue those contrarian calls with conviction is why you are a big fish in the industry. Thank you for sharing your time and your sharks with us.
Thank you very much for having me on, and love to come back anytime. And, I'll see you soon, my friend.
Thank you, Rafael, please.
Thank you, guys. Amazing conversation. Thank you, Flavio, for an invitation. Thank you, Greg, for opportunity to know you.
Okay, guys. That's all for today on Traders of the World. A huge thank you again to Craig Johnson of Piper Sandler. Happy Thanksgiving. Have a good, well-seasoned turkey. Until next time, stay disciplined, watch those long-term charts, and keep connecting the dots. Take care.
That was a lot of fun. Thanks for having me on.
Okay. Keep warm.
Well, we'll stay warm, and, it looks like they're doing a good job of cleaning stuff up. I don't think there's any snow coming anytime soon. Maybe he'll put me on an airplane and come down to see you guys, too.
Oh, that will be great. We will have a caipirinha together.
Yeah, absolutely. All right.
Okay,
Bye, guys.
bye. Thank you very much.